If you're a real estate investor, you know that depreciation is one of your most powerful tools. But here's the thing, its entire strength hinges on one single number, your depreciable basis. And if you get that number wrong on day one, you commit what we're calling the original sin of real estate tax. It's a mistake that can quietly and seriously undermine your returns for years and years.
This quote really gets to the very heart of the matter, and it's the core logic behind Internal Revenue Code Section 167. The idea is really simple. The building you own, that's a wasting asset. It gets old. It wears out over time. But the land it sits on? Well, the IRS sees that as having an indefinite life. This distinction is completely non-negotiable, and it is a starting point for everything we're about to dive into.
So, here it is. Let's put a formal definition on it. The original sin isn't just some small clerical error. No, it's a fundamental misclassification. It's when you allocate 100% of a property's purchase price to the building, which, if you think about it, effectively claims the land underneath is worthless. And that just flies in the face of foundational tax law. Committing this sin creates a liability that just grows and grows with every single tax return you file. Each year you take that inflated depreciation deduction, the problem gets bigger. But don't worry, this explainer is the technical blueprint you need to get it right from the start and, more importantly, to defuse that ticking bomb.
All right, so before we can even think about subtracting the land, we have to build up the total cost. This is the absolute foundational step, and trust me, it's a lot more complex than just looking at the price on the sales contract.
At first glance, this equation looks super simple, right? Purchase price plus your eligible closing costs. But the real complexity, the place where the first critical mistakes are often made, is hidden in what actually qualifies as eligible costs.
You see, tax law demands a really strict three-way classification of all your closing costs. You can't just lump them all together and call it a day. Some costs get added to the property's basis itself, others are amortized with the loan, and a third group can be expensed immediately. Let's break down how that actually works.
Okay, now what's really important to see here is the precision that's required. For example, your title insurance, per IRC Section 263A, has to be capitalized and depreciated. But then you have your loan origination points. Under IRC Section 461G, those get amortized over the life of the loan. And things like prepaid property taxes, well, you expense those in the current year under IRC Section 164. Every single cost has a very specific home, and it's all backed by statutory authority.
So, now that we've established our total capitalized cost, we can finally tackle the heart of the issue, performing a truly defensible subtraction of the land's value. There are a few ways to do this, and you need to know that each one comes with a very different level of risk. So the most common approach you'll see is the Assessor Method. You basically go to the county tax card, find the ratio of the improvement value to the total assessed value, and then you apply that same ratio to your own cost basis. The IRS often accepts this as a reasonable safe harbor because you're using a third-party government source. But, and it's a big but, it isn't foolproof.
Now, if you want the highest level of audit defense, the absolute gold standard, nothing beats a professional appraisal. The critical instruction here, the thing you have to tell them, is to provide a specific value for the land as if it were vacant. This expert opinion is incredibly difficult for the IRS to challenge, which makes it a really strategic investment in your own compliance.
Then there's a third, and frankly much riskier method. That's using the replacement cost from an insurance policy. The problem here is simple. Replacement cost is not the same thing as fair market value. It's a different concept. This approach almost always understates the land's true value, which puts you right back in danger of committing that original sin.
So here's the bottom line when you put them side by side. The appraisal method gives you the highest defensibility, period. The assessor method is a reasonable fallback. But the replacement cost method, it carries significant risk because it's confusing two totally different valuation concepts.
And look, this isn't just about good practice. It's backed by actual judicial precedent. In the case Laird v. United States, the court affirmed that just like the Atlanta Falcons football team could depreciate their player contracts, you, as a property owner, have an obligation to separate the value of your wasting asset, the building, from the non-wasting one, the land.
Now let's switch gears and talk about a particularly dangerous scenario, converting your personal home into a rental property. The rules here are different, and they create a very specific trap for anyone who isn't paying close attention.
The governing rule you have to know here is found in Treasury Regulation Section 1.168-I-4B. It's known as the lesser of rule. When you convert a home to a rental, your depreciable basis is not just what you paid for it. It's also not what it's worth now.
It is the lower of your adjusted cost basis or the fair market value on the exact date of conversion.
This rule has two very different outcomes depending on the market. Let's say we're in a rising market. Your basis is capped at your original cost. You simply cannot depreciate the unrealized appreciation that happened while it was your personal home. But in a declining market, you're forced to step your basis down to the lower fair market value, and you permanently lose that chunk of basis for any future depreciation.
Need proof of how high the stakes are? Look no further than the recent tax court case, Smith v. Commissioner. In this case, the taxpayer couldn't provide any credible evidence for either their cost basis or the fair market value at the time of conversion. They just offered up guesstimates. The court rejected them entirely and ruled their depreciable basis was zero, nothing.
The lesson from this case is severe, but it is crystal clear. The burden of proof is 100% on you, the taxpayer. If you cannot back up your basis with documentation, I'm talking original closing statements, a retrospective appraisal, your deduction can be disallowed completely.
Okay, so after all this careful, meticulous calculation, the final step is reporting it correctly. It all comes together on one place, IRS Form 4562, Depreciation and Amortization.
For a residential rental, you're going to be focused on line 19H. Now, column C, basis for depreciation, this is the moment of truth. This number must be your building basis only after you've subtracted the land. Then, column D is 27.5 years, and column E will be the mid-month convention.
So, what does an IRS agent see when they look at this? Exactly this. If your purchase price was $500,000 and the basis you're depreciating on Form 4562 is also $500,000, that is an immediate glaring red flag. It's a dead giveaway that you probably failed to allocate any value to the land.
And the consequences are not trivial. A mistake like this can easily lead to an automatic adjustment, a big bill for back taxes and interest, and, on top of all that, a potential 20% accuracy-related penalty under Internal Revenue Code Section 6662. So let's just quickly recap the key steps for compliance. First, you have to precisely categorize all your closing costs, no lumping them together. Second, you must use a defensible method to value and subtract the land. Third, if it's a conversion, you absolutely have to apply that lesser of rule correctly. And finally, you have to report that final building basis accurately on Form 4562. And this all brings us to our final question, one for you to really consider. Is your tax return right now a document of compliance, or is it a ticking time bomb? The answer almost always starts and ends with how you valued your land.